Hi, welcome back to Concierge CPA. I am Juliette, and in this video, we're going to talk about one of the most common financial puzzles businesses face. Your income statement shows a healthy profit, but when you check your bank account, the cash just isn't there. How can both be true? How can your income statement and your cash balance be so different? In this video, I'll explain the real difference between profit and cash flow, show you why businesses can look great on paper but still struggle to pay their bills, and give you a few practical ways to stay ahead of the problem. If you're a business owner, this will help you understand why profit doesn't always mean cash in the bank and what that means for running your company. If you are an accounting student, this ties directly to the cash flow statement. You'll see why operating cash flow is reconciled back to net income and how financing and investing flows explain cash movements that never touch profit. Mastering this concept is key to understanding how the three financial statements connect. And stick with me until the end because I'll share the single biggest cash flow trap I see even profitable companies fall into, and how you can avoid it. So let's do this. Let's start with profit. Profit is simply revenue minus expenses. Revenue is every source of income your company earns, from selling goods, providing services, or even earning interest. Expenses are everything the company spends to operate. That includes day-to-day costs like rent, payroll, and supplies, but also interest expense, gains and losses, depreciation, and even taxes. When you subtract all of those expenses from your revenue, you get the very last line on the income statement, net income or net profit. That number tells you how profitable your business looks on paper. So you're looking at this bottom line, net income, and you're thinking, my cash balance in the bank should be around the same. You might recognize that there could be timing differences like customers paying late or bills that haven't cleared yet. And that's true, but timing is only part of the story. Your income statement will also show permanent differences. These are items that affect profit but never actually move cash. So we got two kinds of gaps between profit and cash. Temporary differences, which eventually even out, and permanent differences, which never touch cash at all. Now let's talk about where those temporary differences come from. The answer is accrual accounting. Most companies follow accrual accounting, which is required by GAAP. With accrual accounting, revenue is recorded when it's earned, not when the cash is collected. If you provide a service today and invoice the client for $5,000, that $5,000 goes on your income statement immediately, but your cash balance won't change until the client actually pays. Expenses follow the same rule. They are recorded when they are incurred, not when the bill is paid. If your utility bill for the month is $1,200, it shows up as an expense on your income statement, even if you don't pay it until next month. Accrual accounting is a very smart system and it knows cash is not affected yet. That is why when we prepare the journal entry to record the revenue, we debit accounts receivable, not cash. And when we record an expense we haven't paid for yet, we credit accounts payable, not cash. Notice the accounts here. Both revenue and expenses show up right away on the income statement, which means they are already affecting your income. But the other side of the entry isn't touching cash. It's going to accounts receivable or accounts payable. That's the disconnect. Profit changes immediately, but cash doesn't move until those receivables are collected or those payables are paid. Now let's talk about permanent differences. Items that show up on your income statement and affect your profit, but never actually move cash. The first big one is depreciation and amortization. These reduce your profit each period, but they don't take $1 out of your bank account. They are just a way of spreading out the cost of an asset over time. The second example is unrealized gains and losses. If you hold certain investments and their market value changes, accounting rules may require you to show that gain or loss on your financial statements. But here's the key: no cash has actually moved until you sell that investment and the cash changes hands. Those gains or losses are only on paper. The third is impairments or write-downs. If the value of a piece of equipment or goodwill is reduced, you will record an expense that lowers profit. But again, no cash leaves the business. So those are 3 of the most common permanent differences. There are others too. Things like stock-based compensation, deferred taxes, and certain non-cash gains and losses. I won't go into detail on all of those, but just know they exist and they can make the gap between profit and cash even wider. Now let's talk about cash flow. Cash flow is the actual money moving in and out of your bank account. It's the checks you've written when they clear, the wires you send to pay vendors, and the customer payments you collect on outstanding invoices. Cash flow doesn't care about GAAP or accrual accounting rules. It's simply the real timing of money moving in and out of the business. Most of these transactions, as we covered earlier, do show up in your income statement at some point, just not always in the same period. That's what creates the timing difference between your net income and your bank balance. But remember, there are also permanent differences. Some items reduce profit without ever moving cash. And the reverse is also true. There are cash movements in your bank account that will never appear on your income statement. These also widen the gap between profit and cash flow. For example, when you take out a loan, the cash hits your bank account immediately, but that's not revenue and it won't show up on your income statement. If you repay the loan principal, cash leaves your bank. But that repayment doesn't reduce profit. It reduces the liability on your balance sheet. If your investors put money into the company or you issue stock, your cash balance goes up. But again, there's no income being recorded. And when you buy equipment or other assets, it's a cash outflow, but it doesn't hit the income statement as an expense right away. Instead, it gets capitalized and expensed slowly over time as depreciation. So just like some profit items never affect cash, some cash movements never affect profit. That's why your bank account balance, your profit, and your cash flow statement all tell a very different story. So when you look at your bank account, remember, it's not just a mirror of your income statement. So it's just to recap. Some things reduce profit without ever moving cash, like depreciation or impairments. And other things move cash without ever showing up in profit, like loan proceeds, loan repayments, investor contributions, or buying equipment. That's why your profit and your bank balance rarely match. They're measuring 2 different realities. This is exactly why the cash flow statement exists and why it's such an important part of your financials. The income statement shows your profit, but the cash flow statement takes that profit, adjusts it for all the timing and non-cash items we've talked about, and shows you the actual cash your business generated or used during the period. So how do you stay ahead of this? The real danger isn't just that profit and cash don't match, it's that you can end up short on cash. That means not having enough in the bank to cover payroll, pay vendors, or keep up with rent and loan payments. In the worst cases, businesses expand too fast. Sales grow, but receivables balloon. And suddenly they're overdrawn even while showing a profit on paper. Here are a few practical ways to protect yourself. First, track your receivables like your business depends on it, because it does. Profit doesn't pay the bills, cash does. Set clear collection terms and follow up quickly when payments are late. Second, manage your payables carefully. Don't pay vendors earlier than required. Stretching payments responsibly without damaging relationships keeps more cash in the bank when you need it. Third, separate operating cash from outside monies. Loan proceeds or investor contributions can boost your bank balance, but they don't mean your business is generating healthy cash on its own. Don't mistake borrowed or invested money for operational strength. And finally, build a simple cash forecast. Look ahead 13 weeks, even just on a spreadsheet. Map out what's coming in and what's going out. That visibility helps you avoid surprises and gives you time to adjust. Now, here is the single biggest trap I see, even in companies that look profitable. It's growing faster than your cash flow can support. Sales increase, expenses rise to keep up, but the cash from customers lags behind. Receivables pile up, payables soon become overdue, and suddenly the business has no liquidity left. This is how companies grow broke. On paper, they look successful, but they collapse because cash flow can't keep pace with profit. The only way to avoid this is to keep collections tight, watch growth carefully, and never rely on profit alone to judge financial health. So here's the bottom line. Profit shows how your business performs on paper. Cash flow shows whether you can actually survive day to day. Both matter, but it's cash flow that keeps the lights on. If you're a business owner, keeping a close eye on cash will help you avoid overdrafts, late payments, and growing faster than your cash can support. And if you're an accounting student, this is the foundation for understanding how the income statement and the cash flow statement connect. Well, I'd love to know what you want to see next. Should I make a full deep dive into the cash flow statement, breaking down operating, investing, and financing activities line by line? Let me know in the comments below. And if you found this video helpful, don't forget to like, subscribe, and check out my other videos on accounting basics and financial clarity. Thanks for watching, and I'll see you in the next one.